The vault is opening. What I'm about to unseal was buried in institutional liquidation files, while most market commentary was still trying to explain the headline number. And what the sealed positioning data reveals about last week's shakeout changes how you read precious metals markets, possibly permanently. Marcus Sterling here, the vault keeper. Where the secrets institutions bury get unsealed. Last week, gold and silver didn't just dip, they got slammed so hard that the charts looked like someone yanked the floor out from under the entire metals market. Silver printed a high in the low 120s. Then it unraveled so fast it felt like a trap door, dropping into the low 70s, at the worst moment of the flush before snapping back into the mid-80s. That's not a normal pullback. That's a gut punch move that resets expectations, wipes out leverage, and, according to the sealed institutional files, tells you something critical about the structural condition of the market underneath. But here's what they buried in the positioning data that almost nobody is connecting. While the screen price was falling off a cliff, the real-world demand for physical metal was starting to heat up like a pressure cooker with the lid welded shut. Before we proceed with the unsealing, I need to know whose company we're keeping inside this vault. Tell me in the comments, where are you watching this from? This intelligence is global. The liquidation mechanics I'm about to expose operated across exchanges, vaults, and supply chains simultaneously. Now let me show you what the sealed files reveal that makes this shakeout different from every normal correction explanation you've heard. The selling pressure is only half the story. The other half is what happened on the ground with coins, bars, inventories, spreads, and premiums. And when you connect those dots through the institutional data, you start to see a very different picture than the one the headline price is painting. First, the hard numbers on silver from the sealed market structure files. Silver ran up into the low 120s and then dropped into the low 70s at the worst moment of the flush before snapping back into the mid-80s. On the day of the worst hit, silver's dollar drop was the biggest single-day nominal fall people can remember in this era. Now, percentage-wise, it wasn't the worst of all time. The record for percentage pain still belongs to a historic episode decades ago when a highly concentrated speculative frenzy in silver finally got squeezed. Margin rules tightened and forced selling cascaded. That day, silver got cut in half. But here's the key distinction the vault data forces you to understand. Back then, the dollar move looked smaller because the starting price was smaller. And that's exactly why this latest slide felt impossible to most people watching. Now let me address something that's been floating around the institutional analysis community. You might have heard people calling this a 10 sigma type of event, like it's some once-in-a-lifetime mathematical glitch. I get why that's catchy. It sounds like the system broke. But the sealed files give you a more grounded way to interpret it, because if you understand this, you'll stop being shocked by volatility and start reading it like an institutional signal. Financial markets are not clean lab experiments. They don't follow tidy bell curves when there's leverage, margin, and forced liquidation involved. The vault structural data shows, in real markets, returns have fat tails, big moves cluster. When one big player or a chain of players gets hit with margin calls, the mathematics change because it's no longer a normal market. It becomes a liquidation machine. That doesn't mean it's fair, it means it's a structure problem. And structure problems create the headline moves that shock everyone watching. So instead of asking, how could this happen? The sealed intelligence shows the smarter question is, what had to be true for this to happen? And that question takes us straight to the most suspicious detail of the entire sell-off: circuit breakers. A lot of institutional observers noticed that as metals were sliding, the normal breaks that should slow trading didn't seem to catch the move the way you'd expect. And that set off a wave of speculation. Was the exchange ignoring its own limits? Or did the market simply not hit the specific conditions that trigger a halt? Here's what the vault data reveals is real. Futures markets can have daily price limits and different rules by product and session. Those limits can shift depending on the contract and the day. Now, that doesn't answer the emotional part, the why did it feel like there were no guardrails part. Because what people felt was this: when price is ripping upward, liquidity can vanish. And when price is dumping, liquidity can vanish too. But on the way down, it often feels like the system is happy to let it fall, because forced selling is orderly to the people who care about clearing. That's the uncomfortable truth the sealed structural files document. The market's plumbing is designed to survive, not to protect your feelings. And if you're wondering why I'm drilling into this, it's because this exact dynamic is what separates paper price from physical reality. And we're going to that next. Before we do, one thing you must keep in mind from the institutional context files: even after the beatdown, silver is still up compared to where it started earlier in the cycle. That tells you something the sealed data confirms. The long-term pressure hasn't magically vanished. This move might be a reset, not a funeral. Just when the liquidation mechanics seem clear, there's one classified data point that inverts the entire picture. By the end of this briefing, you'll discover the institutional signal that connects the paper crash to the physical demand surge to the regional pricing divergence, and almost nobody has unsealed these files together. Stay with me, because what's buried in the final segments isn't speculation. It's documented market behavior, and it may permanently alter how you interpret what happens when markets go violent. Now here's where it gets interesting, where the vault opens to the part that the sealed files show most analysts are deliberately ignoring. While the screen price was crashing, the physical market was sending the opposite message entirely. Multiple dealers were describing a surge in people trying to lock in metal, especially silver, because they saw the drop as a rare chance to get in before premiums expand again. And some large mints and wholesalers were describing demand interest that reminded them of the chaos during the lockdown era. This is where you need to pause and let the institutional logic sit. If silver is collapsing on screen, why are people trying to buy it like it's disappearing? That contradiction is the entire game, because paper can move instantly, physical moves slowly, and when paper price collapses faster than physical supply can respond, the gap shows up in one place, premiums and spreads. And there's another clue that's even louder. One the vault positioning data shows is critical: regional pricing. From recent market data, silver in Shanghai has been trading at a meaningful premium to Western benchmarks, and that premium widened as demand spiked. If you can buy something for one price in one part of the world and its price is significantly higher somewhere else, that is not a fun fact. That is the market screaming that supply is tight, logistics are constrained, and local demand is paying up to secure metal now, not later. Now let me unseal the regional pricing mechanics, because this is where the sealed files show the real story is hiding beneath the headline crash. Do I want you to assume every premium is pure scarcity? No, the vault structural data is clear. Premiums can include taxes, import costs, shipping, financing, purity differences, and local market frictions. But when the premium balloons and sticks, which is what the institutional data shows happening in Shanghai right now, it still tells you one critical thing. The real metal is not flowing effortlessly to meet demand. And this is where a lot of institutional observers get it wrong. They think if there's a premium in one place, someone will just arbitrage it away. In theory, yes. In practice, the sealed logistics data reveals arbitrage is limited by regulation, transport, time, and available inventory. And when the market is stressed, those constraints become walls. So when you hear silver is significantly higher in Shanghai, don't just treat it as gossip. Treat it as a stress test result. The vault files document exactly what regional premium divergence means. Supply chains are under strain, local demand is concentrated, and the gap between what paper says the metal is worth and what physical buyers are actually paying is widening. Now let's unseal the big institutional question. Is this sell-off a healthy correction, or is it a warning shot? Here's what the sealed data shows, and I'm going to keep it honest. A correction after a parabolic move is normal. It's almost required. Markets don't go straight up in a clean line unless there's some external price control, and even then, they eventually gap. The faster something rises, the more leverage accumulates, and the more fragile the move becomes. The vault structural files document this pattern consistently across every major metals repricing event. So yes, the sell-off can be a reset. But there's a second possibility, and this is the one the sealed intelligence shows should keep you watching. The sell-off can also be a hunt for liquidity. And when a market is hunted for liquidity, the decline doesn't stop at reasonable levels. It stops when enough forced sellers are wiped out and enough buyers step in with size. That means the bottom isn't set by logic. It's set by pain. And that's why this matters. If what we just saw was a forced liquidation event, then the rebound can be violent in the other direction once the forced selling is done. And the people who sold in panic become the people chasing later. So what should you watch now? The sealed monitoring framework reveals 5 critical signals. You watch whether physical premiums expand, you watch whether delivery times stretch, you watch whether futures spreads behave oddly, you watch whether the gap between regions narrows or widens, and you watch whether volatility stays elevated, because high volatility tells you the market is still unstable. And here's another angle. The vault data reveals that helps explain why it felt like the market didn't make sense during the crash. Most people watch the spot chart and assume that's the whole market. But the sealed structural files show the spot chart is really a reflection of multiple layers: futures positioning, options hedging, dealer inventory management, and sometimes pure mechanical selling when risk desks hit their limits. When volatility spikes, margin requirements can effectively rise even if the official rules don't change, because brokers tighten risk. Clearing firms demand more collateral, and anyone who is overextended suddenly has to come up with cash fast. That's when you see the weirdest behavior the vault files document. Perfectly rational long-term holders don't want to sell. But leverage players have no choice. They sell the most liquid thing they own. And in metals, that often means futures. That's also why the physical market can be screaming tight at the same time the paper market is dumping. The futures market can clear in seconds. The physical market clears in trucks, vaults, and refinery schedules. Different speed, different rules. The sealed logistics data makes this distinction brutally clear. Here's a practical example from the institutional supply chain data. If you're trying to buy common retail products, 1-ounce rounds, small bars, government-minted coins, the supply chain has bottlenecks. Blanks have to be sourced. Fabrication capacity is limited. Shipping has constraints. When everyone shows up at the same time, the first thing that happens is not that the world runs out of silver. The first thing that happens is the easy-to-move inventory gets snapped up, and the premium rises to slow demand. That's how you get a day where the screen price is down hard, yet your checkout price is more expensive than it was the week before. And it's not just retail. In stressed moments, which is what the sealed stress indicators show we're in, you can see tightness show up in the way metal is borrowed and lent behind the scenes. Lease rates can lift, spreads can act jumpy, and the market starts paying a higher price for metal now versus metal later. You don't need institutional credentials to understand what that implies. The vault data is clear, urgency. Now zoom out one more step because the sealed files show this crash didn't happen in a vacuum. When a big move hits, exchanges and brokers respond in different ways. We even saw some markets put temporary limits on how wildly metals-related exchange-traded products could swing in a single session after the breakdown, basically forcing a cooling-off period for retail exposure even while the underlying metal was still chaotic. That tells you something critical. The Vault Intelligence documents. Regulators and exchanges know volatility can turn into a confidence problem. And when confidence becomes the issue, the next move can be even sharper, either direction. So if you felt whiplash during last week's action, you're not weak. You're just watching a market go through a documented stress event. And here's the institutional reality that stress events reveal. They often create the best information. They expose where real demand is hiding. They show which parts of the system are fragile. This week, the sealed data suggests the market is about to tell you which parts held and which parts cracked. And there's a bigger thing happening underneath gold and silver that most people aren't connecting, a structural force in industrial metals that changes the entire hard asset conversation. And it starts with copper. Stay with me, because what the vault files show about copper's demand mechanics connects directly to silver's industrial deficit in a way that reframes everything about last week's shakeout. Now, let me unseal the copper narrative, because while everyone was staring at the precious metals drama, the sealed industrial demand data shows copper is sitting there like a coiled spring. And if copper decides to run, it changes the inflation conversation, the manufacturing conversation, and the hard asset conversation entirely. Here's the big institutional idea that keeps surfacing in recently published numbers and industry studies. The world is trying to electrify everything, and copper is the wiring inside that future. Demand projections out to the early 40s are massive according to the sealed supply forecasts. Some forecasts point to annual demand rising from around the high 20s of millions of metric tons today to the low 40s by that horizon, and a supply gap that could leave a meaningful chunk of demand unmet without major new investment. That's not a small mismatch. That's a structural problem documented in the Vault industrial files. Now, to be clear, the sealed data also shows forecasts are not guarantees. Demand can be delayed, substitution can happen, recession can hit, projects can get canceled. But here's the reason copper keeps coming back to the center of the institutional story. Even if the world slows down, the infrastructure build-out doesn't stop. Data centers still get built, grids still get upgraded, defense systems still get modernized, energy transition projects still move forward, sometimes slower, sometimes faster, but the Vault demand files show they don't vanish. And here's a data point from recent institutional reporting that matters. Major miners reported that copper output has been pressured by declining grades and operational constraints, even as long-term demand expectations keep climbing. So you've got this institutional tug-of-war, the sealed files document. Supply growth is hard, demand growth is sticky, and price becomes the pressure valve. Now let's bring that back to gold and silver, because there's a reason the Vault framework pairs these together. When the market gets hit with a sudden liquidation, everything can drop together at first. Gold, silver, copper, whatever. If it's liquid and held with leverage, it can get sold. That's the sell what you can phase documented in the sealed liquidation data. But the rebound phase is where you see the truth. The rebound phase shows you what people actually want to own when the panic clears. And that's why the physical demand story matters so much in the institutional analysis. If the sell-off was paper-driven and the physical market stays tight, then the screen price can snap back and the premiums can stay elevated. That creates a weird feeling where people say price dropped, but it's not actually cheaper to buy. The Vault supply chain data confirms this pattern is real, not imagined. Now let me add one more layer of institutional context that connects everything. Silver isn't just a shiny metal people hoard, it's also a critical industrial input. The sealed demand data shows. In recent years, industrial demand has been a massive slice of total silver usage. and the market has been running deficits, meaning demand has been higher than supply for multiple years in a row. That matters because the vault structural files document. Deficits don't always show up instantly in price. Deficits can be masked by inventories, recycling, and financial flows. But over time, sustained deficits tighten the system. And when the system tightens, it doesn't take much, one strong wave of retail buying, one supply hiccup, one surge in industrial demand, for the whole market to feel like it's short metal. That's why the sealed supply data shows people obsess over whether silver is sold out. Now let me be skeptical for a second, because the vault intelligence requires honesty. The phrase, sold out everywhere by tonight, makes for a viral quote. It's dramatic. It's also not always literally true, because there are always layers of inventory, some public, some private, some locked into different forms, some priced so high nobody wants it, some reserved for industrial users. So instead of taking that claim at face value, here's the smarter way the sealed framework shows you to interpret it. When people say sold out, they often mean the popular products are gone, the backlog is growing, and premiums are rising. They mean the easy supply is gone. And that can happen, according to the vault data, even when the total global silver inventory is not zero. So don't get hypnotized by the drama. Watch the practical institutional signals, product availability, wait times, premiums. Those are the transmission mechanisms the sealed files show actually reveal what's happening. Now let's get back to the price action, because this is where the next piece of classified intelligence sits. We saw the dump. We saw the bounce. The question the sealed institutional data forces is that bounce the start of a new leg up, or is it a dead cat bounce before the next wave down? And the answer depends on one thing the vault mechanics document clearly: whether the market can stabilize without crushing demand. If silver stabilizes and demand stays hot, you get a base. If silver keeps whipping around and premiums keep climbing, you get stress. And if you get stress, the sealed flow data shows you can get another spike that shocks people who thought the story ended with the crash. That's the part the vault intelligence wants you ready for, because the market loves to punish certainty. Now, gold. Gold had its own ugly moment during this shakeout. The drop on gold was not as extreme as silver in percentage terms, but it was still a big move for a metal that's usually treated like the calm adult in the room. And when gold moves like that, according to the sealed institutional positioning data, it tells you liquidation was broad. Not isolated, not sector-specific, broad. But gold also has a different engine than silver. The vault data makes this distinction critical. Silver is part monetary, part industrial. Gold is primarily monetary and reserve-driven. That means when gold gets hit, it's often about dollars, yields, and positioning. So when gold drops hard and then steadies, the sealed framework shows you need to start watching currency dynamics and real rates. Because if the market starts pricing easier policy or weaker purchasing power, gold has a way of reasserting itself, and the vault data shows this pattern repeating across every major liquidation cycle. Now I'm going to say something that might annoy both sides of this conversation, because the sealed intelligence requires balance. Bulls want every drop to be manipulation. Bears want every spike to be a bubble. Reality is messier. The vault files are clear on this. Yes, large players influence liquidity. Yes, derivatives amplify moves. Yes, narratives get pushed when it benefits somebody. But the deeper truth, the sealed data documents, is that markets are complex, and the same move can have multiple causes simultaneously. A drop can be liquidation plus profit taking, plus risk-off selling, plus a stronger dollar intraday. And that's exactly why simplistic explanations fail. So what's the actionable institutional insight? It's this. In a high volatility environment, you can't just watch the price. You have to watch the transmission mechanism. What's pushing price? What's pulling it? What's breaking? And the transmission mechanism right now, according to the sealed positioning data, includes physical tightness signals and industrial demand signals that haven't been fully priced in yet. But there's one more critical piece that connects copper's structural dynamics to silver's industrial deficit to gold's reserve mechanics. And it involves psychology, the one force that determines whether this week builds a base or sets up another violent move. Stay with me, because the vault data on post-crash behavior patterns is where the real institutional edge sits. Now let me unseal what the vault psychological data shows about what happens after a crash like this, because this is where institutional observers either survive or get destroyed. After a violent shakeout, the sealed behavioral files document. The crowd splits into 3 groups every single time, without exception. Group 1 is traumatized. They say, never again. They swear off metals entirely. They sell whatever they have left and run to cash or equities. They don't come back until the next parabolic move proves them wrong, and by then, the easy entry is gone. Group 2 is euphoric. They say, this is the dip of the decade. They go all in with everything they have, loaded with leverage, convinced the bottom is in and the next spike is imminent. They become the next Group 1 when the market tests the lows again. Group 3 is patient. They say, let the market show me. They watch the signals. They size their positions based on risk, not emotion. They understand that the market revealing information is more valuable than guessing the next tick. The people who survive long-term, according to the sealed institutional survival data, usually live in Group 3. So if you're watching this and your heart rate is up, here's what the Vault framework says. Slow down. Decide what your time horizon is. Decide what you actually own, paper exposure or physical metal. Decide what your goal is, trading, hedging, or long-term wealth defense. Because the sealed data is clear. The same market move means different things depending on your goal. And conflating those goals is how institutional amateurs get wiped out. Now there's one more thread. The Vault intelligence needs you to pull, and it's the thread that links the metals crash to the bigger economy. Liquidity and confidence. When assets drop sharply, people look for what's stable. Some run to cash, some run to bonds, some run to metals, some run to energy and resources. And right now, the reason metals keep snapping back, according to the sealed macro data, is because the bigger backdrop is still unstable. Debt loads are high, fiscal deficits are persistent, and when the institutional data shows that, the appetite for real things doesn't disappear. It just moves around. That's why you can have a crash and a buying frenzy at the same time. Different players are doing different things. The Vault positioning files document this divergence clearly, and it's one of the most misunderstood dynamics in modern markets. Now let me unseal the rebound mechanics, because this is where the next piece of classified intelligence lives. Silver bounced from the low 70s back into the mid-80s. That's a huge move in a short time, but here's what the sealed market structure data shows matters most about rebounds like this. They often create a trap. Why? Because after a violent drop, the first bounce can be fueled entirely by short covering and bargain hunters. It feels good. It feels like relief. It makes people think the danger passed. Then the market tests the lows again. Sometimes it holds, sometimes it breaks. And the sealed institutional data shows the second test is where you learn whether the market is healthy or fragile. The first test tells you nothing about the structural condition. The second test tells you everything. So this week, what the Vault framework shows you should be watching is not whether silver has a green day. It's whether the market can handle selling without collapsing again. If it can, you get a base. If it can't, you get a second wave that punishes anyone who bought too aggressively into the bounce. And that's why the next few sessions could be, let's say, educationally expensive for anyone not watching the right signals. Now, I want to address the bigger trend still intact claim, because you've probably heard that phrase repeated across institutional commentary. The Vault intelligence shows it can be true, but only under certain conditions. If the fundamentals are tight, deficits, industrial demand, constrained mine supply, then yes, the long-term trend can remain constructive even after a crash. The sealed supply-demand data supports this under those conditions. But if the market was being driven mostly by speculative mania, then a crash can be the beginning of a long cooling-off period. And the Vault data shows you can't tell the difference until you look at what physical demand does after the dust settles. So what was driving this shakeout? The sealed files show it was both simultaneously. You had real tightness in the physical market and strong demand narratives, but you also had speculative heat and leverage baked in at the top. When leverage gets flushed, according to the Vault structural data, it doesn't mean the story is over. It means the story changes. The weak hands get cleared out. The structural demand remains. And the next leg, if it comes, will be built on a different foundation than the last one. And that leads to the institutional question that should sit in your mind. What if the flush actually sets up the next rally by removing the weak hands? That's how bull markets often work. The sealed historical data documents this pattern repeatedly. They scare people out right before the next leg. The violence of the liquidation becomes the fuel for the next move, because the people who sold in panic become the people chasing when price recovers. Now let's pivot back to copper for a second, because the Vault framework shows copper gives you a map for how resource markets behave during and after stress events. Copper has been in a situation where the long-term institutional need is enormous, but supply expansion is slow, expensive, and politically complicated. The sealed mining data is brutally clear on this. You can't just snap your fingers and open a mine. Permits take time. Capital takes time. Community support takes time. Infrastructure takes time. And the sealed institutional reports show big players are already talking about supply gaps into the future, partly driven by electrification and data center build-out. So when copper sells off with everything else during a liquidation cascade, the Vault data shows don't automatically assume the copper story is broken. Assume it's temporarily risk-off. Now, the sealed intelligence also reveals something practical that most institutional commentary ignores. A practical framework for evaluating any resource company you see people promoting during these stress moments. Ask 3 questions. The Vault files document is critical. 1, is the asset real or is it a story? 2, Does the company have a path to money, cash flow, financing, or a credible partner? 3. Is the valuation pricing perfection, or is it pricing survival? If you can't answer those based on documented data, not narrative, you're not investing. You're hoping. And hope is not a strategy the sealed institutional files have ever validated. But there's one more critical piece of vault intelligence that connects the rebound mechanics to the physical demand signals to what copper's structural dynamics mean for the next week. And it involves the 5 specific signals the sealed monitoring framework identifies as the transmission mechanisms that tell you what's really happening beneath the headline price. Stay with me, because this is where the institutional edge gets concrete. Now, let me unseal the 5 signals the vault monitoring framework shows you need to watch this week. Because these are the transmission mechanisms that separate institutional observers from people just watching the headline price. Signal 1, premium behavior. The sealed supply data is clear on what premium movement reveals. If premiums rise while price falls, that's a tightness signal. It means physical metal is getting harder to acquire at the spot price. The screen number is disconnected from what buyers are actually paying. And according to the vault framework, this is the single most reliable indicator of real-world supply conditions during stress events. Signal 2. Delivery times. If delivery times stretch, if the time between ordering physical metal and actually receiving it starts to expand, that's a supply friction signal. The sealed logistics data shows delivery time stretching is often more informative than the premium itself because it reveals constraints that premiums can temporarily mask. Signal 3, spreads. If spot tightness shows up in lease rates or future structure, if the cost of borrowing metal rises, or if the relationship between near-month and far-month contracts acts unusually, that's what the vault data calls a metal now signal. The market is telling you that having the physical metal in hand is worth more than a promise to deliver it later. Signal 4, regional pricing. If Shanghai keeps paying up relative to Western benchmarks, the sealed geographic data shows that's demand concentration revealing itself. It means one region is accumulating physical supply faster than logistics can redistribute. And when that divergence persists, when it doesn't arbitrage away the way it should, the vault structural data shows it's a systemic supply constraint, not a temporary friction. Signal 5, broader risk appetite. If equities and credit markets wobble this week, the sealed cross-asset data shows forced selling can spill into metals again, just like it did last week. Because in a dollar crunch, people sell what they can, not what they want to sell. Now I want to unseal something directly to the person who's holding metal right now and feeling nervous after what happened last week. Because the vault psychological data shows this is where most people make their institutional mistakes. If you're holding metal, you just watched a huge drop, your brain is screaming at you to do something. That's normal. The sealed behavioral files document this reaction consistently. It's hardwired. But the vault intelligence shows the best moves are often made when you're calm, not when you're scared. So ask yourself the question the sealed framework identifies as critical. Did your reason for owning metals change? If you own metals as a hedge against currency debasement and systemic risk, one ugly week doesn't erase that logic. The structural conditions that made you buy haven't disappeared because the screen price moved violently for 5 days. If you own metals as a trade, then your rules matter. Your stops matter. Your risk sizing matters. Different goals require different decisions. And conflating them is exactly how the vault data shows people get institutionally destroyed. Now let me unseal the psychology of profit-taking. Because the sealed behavioral data shows this is where even disciplined observers make mistakes during volatile periods. After a crash and a rebound, you'll hear bold targets tossed around. 5,000, 6,000, beyond, like their destiny. The vault framework says targets can be useful as a compass, but they can also be bait. The real driver isn't a number on a thumbnail, it's the environment that makes those numbers plausible. Persistent deficits, heavy government borrowing, the steady erosion of what a dollar buys over time. If yields rise faster than inflation expectations, gold can struggle. If the real purchasing power keeps slipping while policy stays loose, gold tends to find its footing. Now, that's why the sealed intelligence keeps coming back to real rates and liquidity. It's not glamorous, but the vault data shows it's the engine that drives everything else. And if you want one simple mental model the sealed institutional framework validates, gold is insurance. Silver is both insurance and a raw material. When fear spikes, gold can lead. When growth and electrification dominate, silver and copper can sprint. The rotation between those themes, according to the vault positioning data, is where a lot of institutional observers get chopped up, because they're positioned for one regime and the market shifts to another without warning. Now, let me address the "it's too high" argument, because the sealed price mechanics show there are 2 fundamentally different ways a price becomes too high, and most people only understand one. 1, the asset gets overvalued relative to fundamental reality. 2, The currency gets devalued relative to purchasing power reality. Most institutional commentary only addresses the first mechanism. But the second, according to the vault data, is what matters most in an era of persistent deficits and policy improvisation. And that's why metals can look crazy on screen while actually being perfectly rational when measured against purchasing power erosion. If the measuring stick is shrinking, the numbers rise. Now let me also unseal what the sealed files show about how to think about positioning during these volatile periods, because the vault framework gives you a practical structure that removes emotion from the equation. You don't need to predict the next tick. You need to avoid getting emotional. The sealed behavioral data validates this consistently. If you're building a long-term position, the vault framework shows you can scale in over time instead of trying to nail the perfect bottom. Buy a little now. Buy a little more on dips. Buy a little more when you have new money to allocate. That approach removes the emotional pressure of picking the perfect entry point. If you're trading, the sealed risk management data says, respect volatility and size down, because the market can move farther than you think before breakfast, and leverage amplifies that movement in both directions. And here's the part. The vault intelligence shows nobody likes to admit. Sometimes the best move is to do nothing and just watch the signals. Let the market prove it's done with forced selling. Let the physical market prove whether tightness is real. Let the regional premium prove whether it's sticky or fading, because if the premium stays hot while the screen price stabilizes, that's when the sealed data shows the next breakout can start without warning. And if the premium collapses while price chops, that's when the excitement can bleed off for a while. Either way, the vault framework shows the market is going to tip its hand this week. Your job, according to the sealed institutional intelligence, is to be calm enough to see it when it does. But there's one final piece of classified data that ties everything together. The institutional logic that connects last week's liquidation to the structural demand story to what the sealed files show is the most likely path forward. Stay with me for the final unsealing. Now, let me unseal what the vault intelligence shows is the most likely institutional path forward. Without pretending the sealed data has a crystal ball, the near-term picture the vault framework documents. Volatility stays high. That's just how markets behave after a major shakeout according to every documented liquidation cycle in the sealed historical files. The system takes time to flush, recalibrate, and rebuild confidence. The medium-term picture, the market either builds a base or retests the lows. And the sealed monitoring signals I just gave you are exactly how you tell which one is happening in real time. The longer-term picture, and this is where the vault intelligence gets uncomfortable for people who want simple answers. The structural pressures still exist. Industrial demand, multi-year deficits, the desire for hard assets in an environment of persistent fiscal stress. That doesn't mean price goes straight up. It means the institutional tug-of-war continues. And the winner of that tug-of-war, according to the sealed macro files, is usually determined by the one thing no one controls forever: purchasing power. Now let me unseal one more institutional dynamic that most market commentary ignores entirely, because the vault data shows it's actually one of the most important forces operating right now. The relationship between gold and silver isn't just about price ratios, it's about different engines running simultaneously, and understanding which engine is driving the market at any given moment. The sealed structural data documents this clearly. Gold is primarily monetary and reserve-driven. When fear spikes, when confidence in currency or institutions breaks, gold tends to lead. Central banks accumulate it. Sovereign wealth funds position in it. It moves on psychology and policy expectations. Silver is both monetary and industrial. It moves on fear, like gold, but it also moves on factory orders, solar panel production, electronics manufacturing, and real-world supply chain dynamics. And copper sits at the intersection of industrial demand and energy transition. It moves on growth expectations, electrification timelines, and mining supply constraints. When you understand those three engines, the vault framework shows last week's shakeout makes much more sense. In a forced liquidation event, all three get sold because they're all liquid and held with leverage, but the rebound phase reveals which engine is actually driving demand. If gold rebounds first and leads, the sealed data shows that's a fear trade. If silver rebounds first and leads, you're seeing industrial demand reasserting itself. If copper joins the rebound with conviction, you're seeing growth and electrification demand staying intact despite the volatility. Watch the rotation. The vault intelligence data is clear. That rotation tells you more about what's coming next than any single price target. Now let me address something the sealed institutional files document as critical but rarely discussed. The difference between a market that's done selling and a market that's pausing between waves. The vault mechanics show these look almost identical in the early stages. Both can produce sharp bounces. Both can create optimism. Both can make people think the worst is over. The difference shows up in the signals the sealed monitoring framework identified: premium behavior, delivery times, spreads, regional pricing, and broader risk appetite. If all 5 signals show stability or improvement while price stabilizes, you're seeing a base form. The liquidation is done, the structural demand is reasserting itself, and the next move up will be built on solid institutional ground. If those 5 signals stay mixed or deteriorate while price bounces, you're seeing a pause between waves. The liquidation isn't complete. More forced selling may be waiting in the shadows, and the bounce is just a temporary relief before the next wave hits. The sealed data is brutally clear. You cannot tell the difference by looking at the headline price alone. You must watch the transmission mechanisms. Now, let me also unseal what the vault data shows about leverage and its role in both the crash and the recovery, because this force is invisible to most observers, but drives the majority of short-term price action. Leverage is a multiplier. The sealed structural files document this with devastating clarity. It multiplies gains on the way up, it multiplies losses on the way down, and it multiplies the speed of both. When leverage accumulates at the top, which is what the vault data shows happened before this shakeout, the market becomes fragile. One trigger can set off a cascade of margin calls, and those margin calls force selling into an already falling market, which triggers more margin calls. That's the liquidation machine the sealed files described. It's not manipulation, it's mathematics operating on a levered structure. And on the rebound side, the same mathematics apply in reverse. When shorts get squeezed, they have to buy back their positions. That buying pressure pushes prices up, which squeezes more shorts, which creates more buying pressure. The vault intelligence shows this is why rebounds after violent liquidation can be just as extreme as the sell-off itself. It's not buyers stepping in with conviction, it's shorts being mechanically forced to cover. And distinguishing between real buying and short covering is, according to the sealed positioning data, one of the most important analytical skills for anyone watching these markets during volatile periods. Now, let me pull one more thread that the Vault framework identifies as critical for this week: the relationship between volatility and confidence. The sealed psychological data documents. When volatility stays elevated after a crash, it does something to market participants beyond just moving prices. It erodes confidence. It makes people second-guess their positions. It creates hesitation at exactly the moments when decisive action would be most valuable. And that confidence erosion, according to the Vault data, can become self-reinforcing. If enough institutional observers hesitate, liquidity thins. And when liquidity thins, the next big move, up or down, happens faster and more violently than it should. That's why the sealed intelligence shows this week's trading session is so important. If volatility starts to compress, if the range between highs and lows starts to narrow, that's a sign confidence is returning. And returning confidence typically leads to more orderly price discovery. If volatility stays wide or expands, if the range stays chaotic, that's a sign the market is still processing the liquidation event. And more shocks, in either direction, remain possible. The Vault is preparing for final seal. But there's one last piece of intelligence that connects the liquidation mechanics to the physical demand surge to the 5 monitoring signals. And it involves what the sealed data shows is the single most important question you should be asking yourself going into next week. Stay with me for the final unsealing. The Vault is closing. But before it seals, let me give you the final piece of institutional intelligence that connects everything we've unsealed today. The sealed files force you to confront one question that cuts through all the noise, all the price targets, all the analysis. Did your reason for owning real assets change last week? Because if the answer is no, if the structural conditions that made precious metals relevant to your financial position are still in place, then last week's shakeout was noise, not signal. Violent, painful, gut-wrenching noise, but noise nonetheless. And if the answer is yes, if something fundamental shifted in the macro backdrop in supply-demand dynamics and institutional confidence, then the shakeout may have been the beginning of something larger, a restructuring of how this market works going forward. The Vault data shows the answer. For most of the structural factors is still no. Deficits persist, industrial demand hasn't disappeared, the desire for assets that can't be printed hasn't evaporated. The sealed macro files confirm these conditions are intact. What changed is leverage. What changed is positioning. What changed is the speculative layer that was built on top of real demand. And stripping that layer away, according to the institutional recovery data, is actually healthy for the long-term structural story. Because markets built on real demand last. Markets built on speculative mania don't. Now let me unseal the final institutional framework for thinking about what happens next. Because the Vault intelligence shows this is how the people who survive these events actually navigate them. Step 1, assess your position honestly, not emotionally. The sealed behavioral data shows how much do you own? Is it leveraged? What's your actual exposure? If you can't answer these questions with numbers, not feelings, the Vault framework says you're flying blind. Step 2, match your position to your goal. The sealed framework documents 3 distinct goals, each requiring different behavior. If you're hedging against currency debasement, size it to sleep at night and hold through volatility. If you're trading, reduce size during high volatility periods and let the market come to you. If you're building long-term, accumulate on weakness, not on strength. Step 3. Watch the 5 signals, not the headline price. The sealed monitoring data shows premium behavior, delivery times, spreads, regional pricing, and broader risk appetite tell you more about the real market condition than any single number on a screen. Step 4. Expect another test. The vault historical data documents. After a violent shakeout, the market almost always retests the recent lows. Sometimes it holds, sometimes it breaks. But the test comes. If you're not prepared for that test emotionally and structurally, the second wave will hurt worse than the first, because you'll have already been shaken once. Step 5. Separate the engines. The sealed structural data shows gold, silver, and copper are not the same trade. They respond to different forces. Understanding which engine is driving price at any given moment, fear, industrial demand, or growth, tells you where we are in the recovery cycle. Now, let me close with one more piece of vault intelligence that ties the copper narrative back to silver's industrial deficit, back to gold's reserve mechanics. The sealed data documents a structural shift that's been building for years, and that last week's shakeout did nothing to change. The world is consuming more silver than it mines. It's trying to electrify infrastructure that requires massive copper investment. And it's simultaneously losing confidence in paper-based financial instruments at a pace that's accelerating. Those 3 forces, industrial deficit, electrification demand, and eroding confidence in currency, are the engines the vault framework identified at the beginning of this briefing. And they're all still running. Last week's shakeout flushed the speculative layer. It cleared the weak hands. It created pain that will make some people never touch metals again. But according to the sealed structural data, it didn't change the fundamental supply-demand equation. It didn't stop the electrification build-out. It didn't restore confidence in purchasing power. So the institutional question going into this week isn't whether last week's crash was bad. Everyone knows it was bad. The question, according to the Vault Intelligence, is whether the crash was the end of the story or whether it was the market clearing the board before writing the next chapter. And that chapter, the sealed data suggests, will be written by physical demand, not paper positioning. By real supply constraints, not speculative flows, by the structural forces that were in place before the crash and that remain in place after it. Watch the 5 signals, watch the premiums, watch the delivery times, watch whether Shanghai keeps paying up, watch whether volatility compresses or stays wide. The market is going to tip its hand this week. The sealed files show it always does after events like this. Your job, according to the Vault framework, is to be positioned to see it when it happens. Not to predict it, not to guess it, to see it, and to act on what you actually see, not on what you wish were true. The vault is sealing. The intelligence has been unsealed. Silver shook out violently. Gold followed. Physical demand surged while paper crashed. Regional premiums widened. Copper's structural deficit persists. And the market is about to reveal whether last week was a reset or a warning. Every institutional data point confirms the same reality. The forces driving precious metals demand are structural, not speculative. And structural forces don't disappear because of a 5-day liquidation event. This is Marcus Sterling, the Vault Keeper. The files have been unsealed. The framework has been documented. What you do with this institutional intelligence going into next week is your decision. But understand this based on the sealed mechanics. When markets go violent and then go quiet, the quiet period is not rest. It's information. The Vault data shows the market is always telling you something, even when it looks like nothing is happening, especially when it looks like nothing is happening. We're just reading the sealed files, the institutional positioning left behind in the data. Until the next unsealing,